Today, we are going to talk about one of the greatest wealth creation vehicles in history. It has not only created more wealth than anything else, almost every billionaire can attribute their wealth to the creation of this, and that is the stock market. But first, before we get to that, what is a stock? Now, if you are in business and you own a business, you are going to tend to think of that business in terms of the cash flow it generates. How much money are you making by owning it? However, when we move on to stocks, many people, because they're very easy to trade every day, they stop thinking about what a stock is and what the underlying earnings of that stock is, and instead try to think about what causes it to go up or down. So let us first talk about what is a stock. Now, if we go back 400 years to the Dutch East Indies Company, we could start to get the idea of why stocks were created in the first place. Now, before shares in a company ever existed, whenever an individual did anything, they personally guaranteed it in its entirety. That meant that they were less likely to take risk because if they lost money, they would owe it for the rest of their life, even if it was just bad luck or not their fault that something went poorly. It also meant that people were less likely to give other people money to do things. And so most businesses were very tiny. Now, in the 1600s, we have the Dutch East Indies Company, which is one of the first prominent joint stock companies. And what that meant was two really important things. One, it meant that all of these investors could pool their capital together and give it to an operator who would be responsible for then going out and actually running the business. And the second really important key aspect that was created with these stock corporations was limited liability. Because what that meant was, as an investor, you could only lose up to the amount of money that you put in this venture. Whereas before, even if you only invested $25,000, if this venture went poorly, they could still come back to you personally. So as an investor, you're going to be much more reticent to give anyone your money if not only can you lose what you give, but everything. And so that is why the joint stock corporations, which allowed for pooled capital to invest into different ventures, as well as limited liability, were key in the creation of capital formation. Now, we will not get too much into the sometimes shady history of the Dutch East Indies Company, but what we want you to understand is that as a stockholder in the Dutch East Indies Company, you were entitled to receive a stream of its earnings. And so you were limited in your liability to whatever money you put into it, but your upside was potentially unlimited. It was whatever successful trades that they would embark on would result in your return as an investor, and you were owed a proportional share of those earnings. And so if they made $10 million and there was only 10 shares outstanding, you were owed $1 million. That is roughly how the idea of shares work. Now let us bring it back to modern day and think about this again. There are many people that own a business privately. You may own a business, let's say a footwear retailer that's doing really well. I know, a bit unrealistic, but for simplicity, let's say there's 5 partners that each own an equal share in this business. And so what that means is they each get $1 million a year, because that's $5 million total earnings for the company divided by the 5 partners with an equal share. So that would be 5 million divided by 5 is $1 million a year. So every partner gets $1 million a year. Now, since this is a private company, many people would think about this $1 million a year differently than if it was a public company. But I'm here to tell you that is a mistake. And people who do that are not good investors. Because to be a good investor, you want to think about the shares in the stock that you own as no different than owning a partial ownership in a business. And so if this business that was generating $5 million a year in earnings went public, and let's say they issued 5 million shares, that would mean every share would be entitled to $1 in earnings. And so as an investor, you will be able to value that $1 in earnings and decide what price you want to pay for it. In our last video, we talked about the importance of understanding the distinction between price and value. And so price is what you are paying for a share of stock. Value is the stream of earnings you are going to get back in the future. And understanding that distinction is basically key to being a good investor. Now, a bad investor would look at the price they paid for a stock and would think, what price can they sell it at in the future? They're missing this whole middle step where they're trying to actually value the stock, which again is just a business. And so if I'm going to give you a very simple definition of what is a share of stock, a share of stock is just a partial ownership in a business. That's all it is. And so every time you go to the stock market and you're buying shares in Apple, Google, Nvidia, Tesla, you are actually owning a piece of that business. And as an owner of that business, you are entitled to a stream of all of its future earnings. And so the job as the investor is to figure out, how do I value this stream of future earnings? And once I figure out the value of this stream of future earnings, that will then dictate what price I can pay for the stock. It is no different between being a private company, valuing the stream of earnings, and being a public company, valuing the stream of earnings. In our foot retailer example, the business made $5 million as a private company and as a public company. So in theory, they should both be valuing the shares the same. You should be thinking of investing in a public company and buying shares of the stock as no different than as you buying shares in a private company, because in both cases, you are entitled to the same stream of earnings. And that is really important to understand. And so then what is the stock market? All the stock market is where buyers and sellers come together to try to trade their stock. They are together basically trying to discover what is a fair price for the stock. I want you to think about the stock market as existing as something that is there to serve you. You are not there to go to the market and get a bunch of prices and then try to think about whether or not something is a buy or a sell based off of the prices you are hearing in the market. It doesn't work that way, because if you are reliant on the prices to tell you whether or not to buy or sell something, the problem with that is that what is directing you is basically the entire group of people, because the market itself is just a bunch of other people buying and selling. So if you are waiting until they buy or sell, you are basically relying on them to tell you what you should do. And some people do believe in sort of technical analysis and following trends, momentum, all that. We could talk about that in a future video, but I'm going to go ahead and just say right now, that is not what this channel is about, nor is that what we believe a good investor is. A good investor thinks of buying these shares of stock as no different than buying a partial ownership in a business. When you go out and you buy one share of Apple for $220, you just bought this tiny piece of Apple, and you are entitled to this tiny piece of all of the earnings they generate from their iPhone sales, their Mac sales, their App Store, their TAC revenue from Google, everything together. You are entitled to a piece of that. And you should be understanding that business and how to value it, its prospects for the future, and all of that should be dictating whether or not you want to own that share. It should not be how much the price is moving up and down on a day-to-day. Now, I know some people do like to trade, and that's okay if that's your thing. I'm gonna say something that may be a little triggering, but that's not real investing. It's not, because remember, investing is the process of figuring out the probability of potential payoffs. And if you need another reminder on exactly what investing is, go ahead and click on this video right here.